Hello, everybody. Welcome to the Club 500 meetup. I'm your host, Peter Skobik, and as always, I'm excited to be here with you guys today. So we have a few of our members here joining live, and then we have a lot more who are viewing our video afterwards because we're doing a Facebook Live. We did this kind of mostly for our California folks because our meetup time has moved to 5:30 Pacific time zone, and most of the folks don't actually get back from work in time to actually join us live. So they're going to be watching a recording. I'm going to try my best to ask all the best questions so you guys
I'm here.
all the questions answered. Romain, welcome to the call. Matt, Jamie, welcome to the call. All right, so today is an exciting day, especially for folks who care about taxes. I was just joking earlier with Phil and with our other participants here about how there's very few people in the world who get excited about taxes, but it's certainly something that can make you a lot of money if you pay attention to this call, and it can, I guess, you can save a lot of money in your bank account if you use 1031 exchanges properly. So Phil has been in the industry for a long time and has been doing this since 1982. Phil, correct me if I'm wrong on any of this. And he is one of the founders of the Exchange Resources, Inc., that is a qualified intermediary for 1031 exchanges. He also conducts about 120 to 150 educational seminars per year, hosted by financial planning organizations, escrow associations, CPAs, tax groups, bar associations, and so forth. So Phil definitely knows what he's talking about, which is why I was so excited to have him on today and to answer as many questions as possible that you guys have. I listened to our members on our Facebook group, which is Real Estate Investing, Flipping, and Wholesaling Group, hear about the type of questions you guys have and the type of guests that you guys would like to have. And CPAs and lawyers definitely rank high in the requests. And so I thought that having a 1031 exchange professional would really come in handy, because even CPAs sometimes don't have a full understanding of how it works in the background. So Phil, welcome to the call.
Peter, I'm really happy and honored to be here. So thank you for inviting me.
Well, thank you. Yeah, so I did a brief introduction, but I wanted to maybe start by having you tell us a little bit about yourself and what you do, and then we can go into my questions about 1031 exchanges. I have quite a few because I also don't know enough about them. I kind of understand the basics, but I'd like all of our members to kind of hear it from the beginning. So tell us about yourself.
Oh, just really quickly, you've pretty much covered it. I actually began in the title insurance business in 1982. So I really understand from a title insurance point of view, escrow point of view, of which in parts of the country we have escrow states, and then we have attorney states, but it kind of, for the most part, it works the same. There's just some differences. From a lending point of view, I get a lot of the issues and questions that they have. And then I transitioned into the exchange thing within Chicago Title, which I was there for many, many years. And then I worked as the national sales manager, and I requested my own territory because I remembered a very, very good lesson that the more they pay you in a salary, the more they own you. The more you make in commission, the more you own them. So don't forget that. So the bottom line is I went that route, and it was a very good decision. So so we launched Exchange Resources in 1999, and today we're one of the largest independent facilitators of 1031 exchanges in the country. So yeah, so it's a lot of fun, and I speak, like you said, between 120, 150 seminars a year to all these different groups, including all the Association of Realtors and whatnot. So it's a lot of fun. I thoroughly enjoy it. I hope I can continue to keep doing this for the next few years. Even though I'm at retirement age now, who cares? I mean, the bottom line, I really dig it, and it's fun. And I hope people are always learning new things and they feel comfortable enough to email or call. So always happy to do that.
Perfect. Yeah, and I definitely would want you to share your contact information at the end of our call as well, because we have our chat box on the bottom. And so I'll certainly share my contact, and you can do the same thing for yourself. We've got a few more members joining here. I'm going to admit everybody in here. Let's see here. Mute all upon entry. Okay. All right, so let's just jump right into the questions that I had for you for 1031 exchanges. And guys, if you have any questions in the background, if you have questions during the call, please feel free to list them down below. So you've got a chat box right in the middle of your screen someplace, and you should be able to type your questions down there. I'll keep an eye on the chat. And there we go. Phil already started a conversation there.
Yeah, and of course I hit the return button, so that was that.
But
I'll
there's
wait till the end to
okay.
do that, and I'll
There you go.
show like a little slide that'll have my information on there too.
I feel like that was the perfect opener for our chat. So
thank you. Every yo.
So why don't we do this? Let's start very basic. What is a 1031 exchange, and why is it called a 1031 exchange?
The 1031 exchange was actually born 100 years ago this month. Wow. By Congress, allowing real estate investors to be able to sell their investment properties to defer the capital gains tax, to be able to go into other better properties for them. What's the purpose of that? Well, not only did it defer the capital gains payment, but you see what happens is when you sell and buy property, because that's what an exchange is. It's basically a sale of one party, acquisition from another party. And what it does, it generates a lot of revenue to the IRS, to the Treasury Department, because you have to hire people that are going to, whether it's agents, escrow lawyers, title insurance people, it generates transfer taxes, recording fees, inspectors and lenders and processors, exchange accommodators. Every time we all make money, we have to pay income taxes on that money. And then what do we do with that money after we pay income taxes? We go out and spend. So what it did is it created a win-win for the Treasury Department and for the economy to help people prosper, because the more money they make off of income and more doors that they own, the more money the government makes. So the government always has a reason when they want to expand and give tax breaks, because it generates more money for them, because that's really what it comes down to it. So it's just a deferral. It's not tax-free. It's tax deferred. It's not for the wealthy. It's for anyone who owns investment real estate, whether it's a little plot of land that's worth, $85,000 or maybe $180 million of a skyscraper in Manhattan or downtown Los Angeles. So the bottom line is it could be any kind of investment property can be traded tax deferred. Now, what does tax deferred mean? Well, when you sell a piece of property, you pay basically 4 taxes. Number one, you pay the long-term capital gains tax, and that's usually somewhere between 15 to 20%, depending on a lot of different things. Number two, when they passed the the healthcare program, the Obamacare program, they also instituted an additional tax on sale of property, stocks and bonds and mutual funds and things like that. That generates another 3.8%. And that's all real estate, by the way, your principal residence, your second home, your vacation home, your rental properties, your business use properties, the whole thing. Then you also pay your state if you live in a state that collects taxes, and most of them do. And then you also pay a 4th tax on the sale of investment property called the Recapture of Depreciation tax. So when the government allows you to write off or depreciate the capital improvements on the property, and they give you all this wonderful tax benefit to do so, but they kind of get you at the end because they charge you a 25% tax on the tax write-off they gave you while you own the property. So that's what you're deferring. It allows you to re-leverage, and re-leveraging is so important because that's what investors do. Re-leveraging means they have equity that's grown over time. Now they want to take the equity to buy something that's got more front doors that's going to generate more opportunity for income. The other reason they did this is because if you can diversify, now you have more properties that'll go up in value because of equity rising. So that's also another benefit of doing an exchange, not just the tax deferral, but the income, the additional benefits of appreciation. And thirdly, to be able to acquire more properties and to buy up to create more tax write-offs, the more depreciation. So everybody wins. The government wins, the investor wins, it creates housing, it just creates opportunity for people. And it's one of the best tax deferment that the government has ever come up with. 100 year, happy birthday, 100 years ago this month.
Well, that's exciting. So anytime I've been teaching real estate since 2015, and when I talk about this, I usually tell folks that you can be in real estate for 20 years and never pay tax, other than the property tax, I guess, that your tenants are paying. But when it comes to capital gains taxes, I always say that you can do it tax free, which I know for a professional like you never say tax free, you say tax deferred, because technically you are just deferring paying that tax. But in my mind, isn't it true that you could basically do this forever, in a
Well, I
sense,
mean,
for the rest of your life until you keep 1031ing properties so you don't pay that capital gains?
right. Usually there's a holding period. Most tax people would like to see at least 24 months of holding on a piece of property before they can do another exchange. But Peter, if you own 12 properties and you want to sell all 12 in 1 year and do 12 1031 exchanges, you can do that because you're not flipping. You're simply taking a different property and selling it, re-leveraging equity to make money and everything else we just said. So
Let's say you sell, let's say 12 homes, or maybe one home in California, right? And you buy a apartment complex somewhere else out of state, that would be a like property, and you would not pay capital gains on that. But then let's say in 20 years later, you're selling that apartment complex and you 1031 again, then once again, you've deferred that even further down the road.
we call it swap till you drop. You just keep exchanging until that opportunity and until when you pass. Thankfully, for the last, I don't know, 65, 66, 67 years, the government allows for something called a stepped up basis when you pass. So especially if you have it in a trust or some other vehicle that your estate planning attorney would like to put you in, or your CPA would like to put you in, like a trust. That I think trusts are very nice. Ultimately, what it does is when you pass, you bought it for 300, now it's worth 2 million. And you can send it to your heirs upon your death at a new tax base, not at what you paid for it, but at the fair market value of the property at the date of passing. And I'm going to talk about the American Family Plan that's come down from the White House that is now sitting in Congress that wants to change all that. Okay. And I think it's really important for everybody to understand where real estate is sitting right now. And, the ebb and flow and the peaks and valleys and where we can go depending on what Congress decides to do. So okay. I think it's a real important part of what you need to know of real estate.
So to go back to the basics, so a 1031 exchange is when you exchange one property, where you sell one property, you buy a property of equal or higher value, or does that
equal or higher, and you have to reinvest all the equity from the sale into the acquisition. So the goal is not to touch money. The goal is to sell. The goal is to buy something that's going to be better for you. You can diversify it and put it into multiple buildings. You can put it all into one building. You okay. replace all the cash from the sale. But to buy equal or greater, people don't realize this. Well, you're going to pay off all your mortgage debt when the sale is closed. The government requires that you reborrow the same amount of mortgage or more based on what was paid off when you close your sale. That's how you get back to equal or greater. You're just not replacing equity. Some people think, well, I don't have to, I just have to replace the gain. Not true again. Mm-hmm. The tax people will correct you on that. You have to replace all the cash and all the mortgage replacement. That's what equal or greater really means. So in other words, if I sell for $800,000 and I have $50,000 of non-recurring closing costs, I have to pay commissions and escrow and title and blah, blah, blah. That means if I sold for 800, I really need to buy for 750. Okay. Because I had to pay the $50,000 for non-recurring one-time cost to sell. So the remainder of it all gets reinvested into the acquisition. And because I had to pay all those one-time costs to sell, I don't have to replace that. I could leverage up if I want to, but I'm not allowed to put cash in my pocket.
Okay, so what is they always say it's a like-kind property. It has to be a like-kind property. Can I sell a apartment building and buy a gas station, or what is a like-kind property?
Like-kind means you're selling one of three things: income-producing property, or number two, property that you utilize for your business, or number three, vacant land. It could be farmland. It can just be a vacant lot. And it allows you to go into any one of those three. The government does not say like kind is residential to residential or commercial to commercial. That isn't what it means.
Okay.
It means you're selling investment real estate and you're not going to buy something personal like a primary residence or a second home or a vacation home. But if it's investment to investment and both are real estate, that's what like kind means. And that property could be acquired anywhere in the country. So you're not limited to the state of where you're selling.
Okay. And so if somebody wanted to do a partial 1031 exchange, is that possible?
Yes. Now let's explain what that means. Remember, we just said a couple of minutes ago, you have to reinvest all the cash minus the one-time non-recurring closing costs and reborrow the debt. Well, a partial exchange says you're not going to replace all the debt, or you're not going to replace all the cash. You're going to pay taxes on the difference that you're not replacing. That's partial.
Okay.
You just have to make sure that you always speak with your CPA first, because ultimately you want to make sure that you're buying above your tax basis. So you're still deferring gain, because it is a tax deferred exchange. You're deferring gain. So the bottom line is, some people think, well, I bought it for 300, I'm selling it for $1 million. I'm just going to buy for 200,000. Well, you haven't replaced any gain, because your original basis is $300,000. You went backwards. So that benefit will not be there for you in a 1031 exchange. So the goal is to buy over your basis, and then the difference is partial unless you get back to that equal or greater thing we just spoke of.
Okay. Now, if somebody, let's say somebody bought a property, they partner with someone and they bought a duplex or a quad or something, and they were 50-50 partners in that deal. If they end up selling that deal, can one of the partners 1031 exchange their portion of the deal?
That's a good question, Peter. The answer is it depends on the vesting or the title of the property you're selling. As long as it's not treated or a partnership. Partnership means like an LLC, a corporation, or two individuals that file their tax return on that property to get K-1s as a partnership. So the bottom line is, if you're just regular tenants in common or joint tenants or whatever, you can go ahead and have the one exchange and the other one just pay their taxes. But if it's a partnership, the partnership owns the property, not the individuals. So the partnership then would have to exchange. Like the LLC would exchange, doesn't matter if it has multiple shareholders or members. The bottom line is the LLC owns, so there, which is a partnership. Therefore, the LLC has to buy, and the whole thing has to go into the next property.
Okay, that makes sense. Now, you mentioned earlier holding periods. So let's say, if somebody decided to buy a property to flip. Let's say I buy a flip today. It takes me a couple of months to get it rehabbed. Can I 1031 exchange that flip, or is that too short of a holding period?
Most CPAs feel uncomfortable with that,
okay,
because there was never an intent to hold. It was just an intent to buy, fix, and sell. That's not holding. Even if it takes you 2 years, that's not holding. Why? You never put it into service. It was never rented. So the bottom line is, most tax people have taken the position, actually the vast majority have, is that you cannot do an exchange on a flip, because a flip property is technically considered inventory, and inventory is not exchangeable under Code Section 1031. So you have to be careful. Again, renting fixes everything. And usually it's like time fixes everything. Well, renting does. And as long as you've got 24 months or a couple of tax years of declaring income, showing it on your Schedule E of your tax return, then I think most CPAs are going to be very helpful. It's always important to talk with yours, make sure where they're at. I'm sorry, I forgot to silence the phone. But the bottom line is, yes, even at this late time, I'm still getting phone calls. But the bottom line.
I wanted to, before I go on to my next question, I wanted to also read a question from Jamie Williams. It's actually her first time on a call. Welcome again, Jamie. So her question, I guess she said here in the chat below, she said, she's currently studying for her CPA exam and license. So she says, there are some exceptions on the holding period for residential property. I have recently passed the SEE enrolled agent exam. I have some education and research experience, currently studying for CPA exam and license. So she's saying there's some exceptions on the holding period for residential property. And
Well, or commercial, but let me tell you what that means.
okay.
The intent had to have been very obvious.
Okay.
If the intent to hold is not obvious, then I don't care what exceptions you're talking about. The government wants their money and they're going to get it. They're
Okay.
going to audit you, and you're going to have to prove beyond a shadow of a doubt to that auditor who's going to make that decision what your intent really was based on the way you acted and how you progressed and why it was that way. I'll give you an example. This is a very interesting one. One of my clients has a CPA. One of my CPAs has a client. He refers his clients to us, but this one particular one began at $300,000, and by doing exchanges and whatnot, has actually graduated to the tens of millions of dollars of real estate over time. So what happens is he was making some bids on his exchange, another one that he was doing in a property or was overlooking Newport Beach there in the ocean and everything, Balboa, if anybody knows anything about California. That's a place that everyone would want to own, but better than Beverly Hills, frankly. So anyway, what happens is that he was going back and forth on a purchase, and this other guy was trying to outbid him, but he finally secured the acquisition. So he's in escrow, and during the time he's in escrow, one of his friends is having on his yacht is having a dinner party / cocktail time. So they're out and cruising, having cocktails and hors d'oeuvres and whatnot in Balboa and throughout Newport Beach, which is a really cool thing. So what happens is he's having a glass of wine. He meets this guy and he goes, well, what do you do? He goes, I'm in real estate. Oh, I am too. He goes, what, have you found anything lately? Have you bought anything you like? He goes, yeah. Well, he goes, I just lost this property. He goes, what property is that? Well, some guy and I were going back and forth. I have no idea who he is, but he got a property that he really liked. It was a trophy property, and he wound up getting it. He said, what, really? He goes, where's that property located? It was the same property, the same guy, it turns out he was bidding against. So that guy said to him, I will give you, got to be careful because this is recorded, I will give you $1 million more than what you paid for it if you sell it to me.
Wow.
Did he have the intent to buy and hold that property? Yes. But somebody's knocking on his door here, and not him initiating it, the other party's initiating it, $1 million more. So of course, what did he do on Monday morning? He calls a CPA. The CPA calls us. Our legal department internally got in touch with their legal department and ultimately came to the conclusion he has to show that he truly had no intent to resell the property. He bought it to own because it was a trophy property.
Yeah.
But then later on, the guy had to make an offer to him after closing and approach him. And he had to have a minutia of paperwork supporting that there was no intent to flip. Now, Jamie, that's what it's talking about.
Mm-hmm.
You have to show the intent that you are buying to hold, not to resell. So believe me, the government, when they want their money, they're going to get it.
Yeah, so that's a very, it's a great example of something that happens very rarely, right? So you typically you wouldn't be in that type of situation. It happens pretty rare. So if you are in a situation where you feel like, I've got this property that I'm going to flip, or I'm going to sell it off in a pretty quick fashion without renting it, 99% of the time, that would not be a time to do a 1031 exchange, unless you're holding it for 2 years, you're renting it, and you've got some income producing
documentation on your Schedule A. I mean, that's the perfect kind of documentation that there is. Now, I also noticed Jamie also just sent another one. She goes, section 121 applies to section 1031. No, they don't. They're completely different sections. 1031 is exclusively for investment real estate. 121 is exclusively for your personal residence. So if you have, for example, a fourplex and you live in one of the units and you rent the other 3, you can utilize section 121 on the personal residence portion of the sale, the pro rata portion of that sale, for capital gains taxes. For those of you who don't know what that is, the 121 is they gives you up to $250,000 of capital gain exclusion, not deferment, but exclusion. And then, of course, if you're married filing a joint return, up to $500,000. Now you have to qualify for that. You have to own the property for at least 2 years. You have to live in it for at least 2 years or 2 of the last 5 years. But they will allow you to use the personal residence exclusion for the gain on the portion that you what? Live in. For how long? Either the last 2 years or cumulatively 2 out of the last 5. Code section 1031 is exclusively for investment or business use property. So there's a difference, and you're getting kind of close, but I hope this will clarify it. And this is going to make you look really smart in front of your profs. So there you go.
I'll just keep your phone number and my cell phone. I won't try to repeat all of that, but so I guess my next question is, so if I understood correctly, so if I'm in California, I've got a $600,000 house in California and I want to sell that house, I'm living in that house, I want to sell that house and I want to buy 10 investment properties somewhere else, what happens? I mean, does that?
Yeah, it's very doable. As long as you're selling a rental property. And how much are you selling for, you said?
Let's say I'm just saying 600,000.
Okay, 600,000
situation.
So you can buy 6 $100,000 buildings if you want that you're going to rent out. Not a problem.
Okay.
And they can be in different states, and they don't have to close concurrently or simultaneously. They just have to close within the restricted time, not guidelines, but mandates that the feds give us. And I'm sure you're going to ask me about that question.
Yes, that one's been itching me for a while, but like, so I kind of wanted to get into, because a lot of times we talk about 1031 exchanges and people start understanding in a kind of a conceptual terms of what it is and why people use it. But I wanted to really get into the anatomy of a 1031 exchange and how it actually happens, what actually happens, what are the timeframes that are required, and what does somebody need in order to complete one?
All right. First of all, you need to be in escrow. All right. So you have a contract. If both parties have agreed to it, you go to escrow and you have, let's say, a 30-day escrow, for example. We have to be involved as the qualified intermediary, also known as an accommodator, for the seller to be able to defer tax. So we have to sign ourselves into the sales contract as a representative accommodator or qualified intermediary on behalf of the seller for the purpose of facilitating an exchange. It doesn't cost the buyer any money. There's no tax liability to the buyer. This is all on the seller. So we've got to get all our documents set up before closing. I get at least 3 calls a week of people who have closed the sale and now want to do a 1031 exchange, and they have a $150,000 tax liability. Nothing I can do about it. It's already closed. The eggs have been scrambled and I can't put them back to their original shape or, position. Anyway, long story short, we set up the exchange before escrow closes. Once the escrow closes, there are different types of ways to do an exchange. The first one's called a delayed exchange. A delayed exchange says you now have to close what you're going to buy within 180 days beginning the day of closing. So if I close today, today's what, the August the 11th? That means tomorrow is day 1, August 12th. And you have 180 calendar days to close what you're going to acquire. That's roughly $600,000 or greater in value. Okay. But the first 45 days, you have to name the addresses of what you're going to acquire. See, the government is angry and bitter. And the reason why they're so angry and bitter is because every exchange used to be a simultaneous closing beginning 1921 back into the 60s. Until this guy by the name of T.J. Starker asked the IRS to say, look, I want to close my purchases later. And they said, no. Then he went to the U.S. Treasury Department. I don't know if you know the difference between the IRS and the Treasury Department. The IRS answers to the U.S. Treasury Department. That's when you write a check to the government, you pay it to the Treasury Department. You get a refund, you get it from the Treasury Department. But the IRS is the mafia collection arm of the U.S. Treasury Department. So what happens is he sued them both. And you've heard that saying, you can't beat City Hall. This dude was not taking on City Hall in the 60s. He was taking on the United States government, the U.S. Treasury Department, and the Internal Revenue Service. They litigated, I think it was like 20 years. He won. He actually beat the government, and that threw everything topsy-turvy. Now the government was forced to allow you to have as extra time to acquire. Eventually, they settled on 180 days. Why? I don't know. It's 180 days is not 6 months. It's technically 2 to 3 days, depending if it's leap year or whatever, less than a half year. But you've got to close what you're going to buy within 180 days through the accommodator, which means we're holding your equity in between escrows. That's part of the responsibilities the government has given us. And then we will put that money into your acquisitions, and you must close and take title to your new purchases within the 180 days. The first 45 days of that 180 days, you have to name specifically what you're going to buy. Under the 3 property rule, you can name up to 3 different properties and buy any one or multiples of those, whatever you prefer. But if you need to identify 4 or more properties, then the government changes the rules a little bit. Again, so what they do is they say that, okay, you want to identify 4 or more, now you have to identify the address and the fair market value of the property that you're going to identify. Then you have to identify, after with all of those properties you're identifying, you have to add the total sum value of all the properties cumulatively, and that cannot exceed more than 2 times the amount you sold for. So if you sold for $600,000, you cannot have more than $1.2 million of property on your identification list, totaling 4 properties or greater. But if you keep it to, this is crazy, but if you keep it to 3 properties, you don't have to identify value. You can go as high as you want. There's no more limit to 2 times the sales price. If you sell for 600, you can buy for 6 million.
So essentially, it's all very random, just a random series of rules that don't make a whole lot of sense, but they are rules and they have to be followed.
I'm going to give you 5 words that'll change your life. You ready? You want to have your life changed? Here they are. I'm glad this is being recorded. The government wants your money. If you can figure that one out, you'll understand why they do what they do and why they do it this way. It's nuts, but they want your money.
All right. So do people, I guess this is one question that I've always had with the 1031 exchanges. The 180-day period to complete the process, I'm pretty comfortable with that, right? But having bid on probably over 100 property or 200 properties, something in my life, like it feels like 45 days to identify the replacement specifically by address is a little tight. I mean, looking at the market right now, for example, I don't know how your clients do it, but you can be bidding on 10 houses and win 1. And in a multifamily,
if you're lucky,
if you're lucky,
yeah.
Yeah, exactly. So in the multifamily space, it's not any better. It's actually, it seems like it's even worse. There's a lot of people bidding on properties. How do you identify a replacement property within 45 days? Are they struggling with that?
It's a huge problem. That's why the government also now allows, back in, I think it was 1999 in December, or October, whatever it was, they launched something called the reverse exchange. The reverse exchange allows you to do a 1031 exchange backwards.
Oh.
So let you pony up money, buy a replacement property first, and then close the sale up to 180 days.
Nice.
So let you do it backwards. And that's what this reverse exchange thing is all about. And it costs a lot more for 2 reasons. Number one, you have to float money to acquire. So you have a lender that will help you, or you have enough cash to do that in. And number 2, the fees for a reverse exchange are exponentially more expensive because of what the federal government, because they want your money. But what we have to do, we have to set up a holding corporation that'll take title to the new purchase and then hold it until the sale closes. And we have to deed the property that we're holding for you into the person, the exchanger. So the bottom line is, I don't know why my, sorry for the tone beeping that keeps happening. It just keeps telling me all these reminders that I can't seem to stop. But I'm not a tech guy, so
it keeps us alert.
Yeah.
Right.
Hopefully Phil doesn't put you to sleep.
It shows you're busy. It's a lot of reminders. Perfect. Yeah, that was actually the next thing I was going to ask you is if we can buy the replacement property prior to selling the investment property, and it does seem like that would be less stressful. But like you're saying, it is more expensive to do it that way and more legally complicated.
Well, Peter, it's for two reasons. And by the way, I got to give a shout out before I give you that. It's to Nicholas Weaver out there. He's the one who made this happen tonight. So Nick, thank you very much. I
Yes.
appreciate it. So here's the deal. The reverse exchange is there for two reasons. Number one, opportunity drops in your lap. And if you don't take advantage of it, somebody else is going to get it. It's worth spending the extra money for exchange fees. It's worth floating money to acquire it. Because if opportunity is knocking at your front door, can you hear it? And you don't answer it, see you later. It goes to somebody else and you've missed your opportunity. So that's what it was created for. The second reason why we have a reverse exchange is because of markets like this. Very low inventory, very high demand. So that means prices are going up, which means you're going to get outbid. I mean, I'm talking to people out here, $200,000 over asking price. They're outbidding each other. It's insane. It's absolutely insane. So the reverse exchange lets you wait. You know you can sell in the market like this. But the question is, can you find a suitable replacement? Because the key to the exchange is not what you're selling, it's the property you're going to buy and hold. Because that's the one that's going to be generating the income, the appreciation, and the tax write-offs for you. Does that make sense?
Well, absolutely, yeah. So somebody could literally, somebody could choose 3 properties and say, okay, these are my 3 addresses that I plan to buy, and they could be bidding on them. And if they lose them and 45 days, 46 days goes by, it's over. They miss their opportunity, right? And
yeah, now they're the proud owner of 2 properties.
and eventually a proud payer of capital gains.
Yeah.
So what is a qualified intermediary, and do I need to use one? Can I just keep the money in my mom's checking account and then end up using that for the purchase?
A good question. Can everybody see my picture? That's a qualified intermediary. I'm the only person in the world who does this. I'm just kidding. A qualified intermediary is a third-party facilitator.
Okay.
I mean, you can find them online or in the phone book or whatnot. We do this nationally. But the bottom line is...
You say the phone book?
Huh?
You say the phone book? The phone book?
Is there such a thing anymore? You're dating yourself, Peter. Anyway, the bottom line is a lot of real estate professionals would know of one. Certainly attorney and escrow people would know. But the bottom line is you have to hire a company like ours to become that qualified intermediary or the accommodator that assigns themselves into the sales contract, holds the funds in between escrows, and then assigns the money identified to them, and then assigns the money or us into the purchase contract for the replacement property. Now what you've effectively done, and I know this doesn't make sense, but you've traded with us. The property went through us, the new property goes through us. So as far as the IRS is concerned, that assignment without us having to take title anymore, which is good, it is good enough for them, and they've made that very clear. So that's what a qualified, now it cannot be your CPA, it cannot be your attorney, it cannot be your real estate agent. These are people who are helping you with other items like that. It has to be somebody that's all they do is 1031 exchanges, or they've never helped you. Now, I wouldn't do this with they can't be a related party either. So that knocks out, your mom, your dad, your brother, your sister, who's going to walk away with your money anyway. Believe me, I've heard these stories before. But the bottom line is they're not qualified. You need a third-party facilitator that this is all they do.
Nice.
Yeah.
Yeah, good deal. That totally makes sense. And that's kind of in line with what we've heard about 1031 exchanges. And I think another benefit to having an intermediary, I mean, one thing, it's not optional, you have to have one. And secondly, it's a complicated process. And it's nice to have, I guess, someone guiding us through it when it's actually happening.
We have our own internal legal department. That's how technical it is.
Yeah.
We have lawyers who specialize in this. And not every qualified intermediary does. And since you mentioned that, can I just mention a couple of things about a qualified intermediary you have to be careful of and check out if you're not going to use a company like ours? There are some very good companies out there that do this. We're not the only good company, but there's some very not so good companies. Number one, make sure they never, ever commingle your money with all the other money they're holding. You need them to set up a segregated client trust account. Number two, it cannot be a corporate asset of that accommodator, because if they go BK, say bye-bye to your money. They go to the bankruptcy. Pardon me?
What does that mean again? If they go what?
BK, bankrupt.
Oh, okay.
Yeah. And so in number three, make sure the money could never leave that trust account without the client, the exchanger, signing. There has to be a signature, not just a verbal. You cannot believe how loosey-goosey some of these companies are out there, or they'll say, don't worry about the 45 days. We'll just fix the paperwork and all like that. Let me tell you, those people are around for a little while and then they're gone. Usually they're either go bankrupt or they go to jail, and you do not want to work with a company like that, because it's your exchange that's going to be disallowed. And now you're going to have to pay all those taxes that we spoke of. So it's really pays to go the high road, have a good company out there. I mean, for crying out loud, $950. How many hundreds of thousands of dollars on a transaction? It's nothing to make sure that you ensure that your money is safe and sound, and you're working with people. I'm not talking about our company. I'm talking about the other good companies who know what they're doing, and they'll be very good to you. So they answer phones and they answer questions. They don't just make stuff up. It's amazing what's out there.
They come to podcasts.
I'm telling you.
I want to second what you said also. Yeah, thank you, Nick Weaver, for recommending Phil to come to our meetup and to talk to us about 1031 exchanges. How did you guys meet, Nick?
Good question. Nick, you have to unmute yourself.
Oops. Oops, sorry. I was trying to ask you to unmute, but then I accidentally muted you again.
I was waiting for Peter to give me rights to speak. But yeah, actually, Phil is helping one of my future partners through a 1031 exchange. And she was running out of time, and she sold two 8-plexes, I think 2 4-plexes in Texas. And Phil's team is helping her with the 1031 exchange. And through the grapevine, she heard of myself and my brother Derek and what we're doing with turnkey rental properties, and she reached out. So through speaking to her and her scenario, and she put me in contact with Phil, and she's a realtor herself, and she said that Phil was came highly regarded and was going to like realtor like, I don't know, socials, or you were giving speeches at realtor banquets or something. So she knew of you.
Board of Realtors seminars. And
there you go. There you go.
You get their license renewed and stuff like that.
Yep.
Yeah.
Yeah. So she was well versed, and since she was in the middle of a 1031 exchange, and she put me in contact with Phil, and the rest is history.
Hey, folks, it proves a point. Money will buy you anything. No, I'm just kidding.
Good work. No, perfect. Yeah, thanks again for the intro. And I've been asked, actually, because we've had meetups. We started the Club 500 meetups in 2017, and I've had a lot of situations where somebody asked me if I know a good 1031 exchange intermediary. I usually told them to Google it, but now I know an actual name that I can share that I know does a good job with it. So.
We're very honored to answer your questions. There's no obligation. And I mean that sincerely. I mean, folks, all of you, you're in the relationship business. That's really what it comes down to. Do people trust you? Can people get the information they need? Can they go back to their CPA and not get conflicting information? Mm-hmm. It's all about consistency and somebody who's more interested in you than they are themselves. And that's what it's all about. I mean, you do that, you never have to ask for any business it will come to you because of referrals, because people will talk about what they like and what they don't like.
Mhm. Yeah. Yeah. And people have asked me a lot of times. I had meetups, like I said, from 2017, and would come there with a PowerPoint, kind of teaching how to invest in real estate and all that. And I always tell the story. There was one guy who came up to me and he said, "Hey, can I pay you to teach me about real estate?" And I said, I mean, either that or I could just teach you about real estate for free. And he just kind of got confused and never called me again. but that was one question that always came up, is like, why do you teach people about real estate if you're not charging for meetups? And that's exactly what you said, is that you do the right thing, and great things happen in real estate. There's really no secret. It's a relationship business.
When the relationship is more important than money, it is amazing how much money you make. It just is. You just got to have your priorities straight and just think about the other person and know what you're talking about. That's really, really important. I could see I'm getting the sunsetting racing stripes here.
I think it's a great effect. I thought that was a filter that you were doing on purpose.
No, it's not. It's called The Sun Is Setting Behind Downtown LA in the Ocean. That's what it is.
I think Zoom should look into that. Zoom needs to look into that. But yeah, so I want to get to some of the member questions if they have them. I know a lot of times 1031 exchanges can be confusing. I see that Brian is still on the call. I think, Brian, you've had a 1031 exchange recently, or you might be going through one right now.
Yeah. Again, thanks, Phil, for being on. I think this is one of the greatest tools in real estate, the 1031. I think this is incredibly beneficial, because when we actually got introduced to our 1031, we were somewhat rushed. So we obviously got it through referral, but I think what you're speaking on today is truly valuable. So we sold a property here in California, and we're looking to kind of do what you talked about, which is to split some of the proceeds between two different properties. So the struggle we have now is we actually have one property accounted for, but we're rushing to get a second property closed within the next 180 days. So trying to find one and close on one is certainly something that we're somewhat concerned about.
Well, that's a tough feat to have in this marketplace. I think it's thinning out a little bit, though, in terms of buyers are beginning. You're finding a little less in buyers when it comes to properties right now. So it's still happening out there. Sorry, I had to get rid of the racing stripes. But prices are very stable. They're still inching their way up. There's still a frenzy for acquisitions, but I feel like maybe just now things are beginning to level off a little bit, which is a really healthy thing for our industry.
Mm-hmm.
What do you think?
One thing I'm curious, hopefully before the end of the call, is to hear where the administration is going with this, because I think there's some concern that those may have some restrictions, or that there may be limitations in the future. So I'm curious to hear your opinion on 1031 in the future.
Yeah, I'd be happy to. We're really involved, our company, with the Federation of Exchange Accommodators. Actually, a few years ago, I went before Congress. I had a chance to go and to walk Capitol Hill and to be able to meet a number of congressional leaders to tell them, do not get rid of this exchange, and this is why. And we're talking a lot about what we were mentioning today earlier about stimulating the economy and creating more revenue for the Treasury Department and keeping people working, because it just creates a lot of work for a lot of people to be able to sell and buy real estate. Recently, and I'm going to do this the best way I can, so I'll look apolitical. The White House recently handed down, back in, I believe it was April 28th, something called the American Families Plan. And the American Families Plan is very, very deep. The American Families Plan, I'm just going to hit on it, just a few highlights to answer your question, is going to raise the long-term capital gain from 20% as high as 39.6%. That's a huge increase for people, and it changes the real estate sales from long-term capital gain to ordinary income. which jacks that your number up to $1 million a lot faster. Number two, the elimination of the 1031 and tax deferred exchange. They feel like it's too much of a tax write-off for the rich, which to me is insane. I just don't know how they can come up with that kind of statement, because I see small little condos and I see really large properties and that in between. Then they said, well, maybe we'll back off on elimination of the exchange, but we're only going to limit to possibly $500,000. But, I mean, that may be okay in upstate New York, but that's not going to cut any mustard in the big cities all over the country. Just to limit it to $500,000 on a rental investment business use property. The next item that they want to do is to eliminate the stepped up basis. That means, like we discussed earlier, when you pass away, it goes to your surviving spouse or your kids, depending, or whoever your heirs are, depending on how you set it up with your trust or whatnot. Well, under this, the beneficiaries do not get a stepped up basis. They receive the property at the decedent's basis, which means if I bought the property, for $300,000 and now it's worth $1 million and I die, but I have a reverse mortgage on the property, or I've been refinancing to take cash out. So there's a lot of debt, not a lot of equity, but the gain is still there. What happens is my heir then may not be able to keep it, which means they're going to have to sell the property, but there's not enough equity to pay for all the capital gain. That's a real problem. These items, and oh, by the way, it's going to affect opportunity zones for those of you who are familiar with those. The bottom line is this, is that the tax community and the legal community, Wall Street and real estate is petrified that this can throw us into a 10-year spin of recession. This is not good for the American family. It is not good for investors. It's just a grab as much money as you can from anybody who's selling anything. And that's a real concern, because you keep America going by keeping America working. And by being able to sell and buy. You're not going to sell with that kind of tax rate, folks. I mean, when you couple it with the state tax, the healthcare tax, the depreciation recapture tax, you're talking 65%. Really? Well, how many people are going to sell their properties with that? I don't see it. Now, I'm just nothing but a dumb exchange accommodator. But the bottom line is, you think about it. Do you think really people are going to sell under that kind of tax burden? I just think they're just misled and misdriven. And ultimately, in my apolitical way, the bottom line is that I think this is really a bad plan. You can go to 1031taxreform.com. If you write that down, it's 1031taxreform.com. That will take you to a website that the Federation of Exchange Accommodators has launched. We personally have helped pay for that. But what it does, it gives you two opportunities. It educates you as to, at least on the exchange end, what the American Families Plan is asking for and asking Congress to pass, because they've already sent it down to Congress. Now Congress is sitting on a hot potato and they don't know what to do with this. Secondly, it will generate a letter for you, or you can write your own letter. When you type in your address, it will find your House of Representative, person who's going to be voting for this in the House of Representatives, and your state senator in the Senate, and generate letters to them explaining why, either in your words, or if you want to use the letter that the website will generate, why this is a bad deal and how it's going to really cause a lot of recession and slowdown, because that's happened in the past. This is not a new thing. This is just a repeat of a bad thing. So I hope that answers your question. I was a little biased. But the bottom line is, those numbers are not fake. Those are not exaggerated. Those are not made up numbers. Those are in the American Families Plan, which in my opinion is not good for the American family.
I think that was fair. I mean, we stay apolitical on this meetup, but I would say that you've stated facts about what is being proposed and what the impact of that might be. So I feel like that was fair.
Thank you.
And can you repeat? So it was 1031. I'm trying to open the website here. So
1031 www.1031taxreform.com.
So tax reform.
If you'd like, I can show you, if I can screen share, I can.
I'm actually, no, what I'm doing is, oh, okay. And it kind of forwards me to 1031buildsamerica.org.
There you go.
Okay,
That's what
one. Okay.
It'll take you right there. And you'll see in that upper right or upper left what you can do to take a response by either creating your own letter or utilizing the letter that we have. When you put in your addresses, like I said, it'll find your House's representative, your congressional leader, and your senatorial leaders, and it will generate the letters to them to ask them to not to do this. You know, and funny, in California, the ones I've gotten 2 responses back, one from the Senate leader, Dianne Feinstein, and she basically said, we're going to do what we're going to do. That's just the way it is. Said, oh, thank you for listening to me. The second one is a second leader, the new one that was newly appointed. After reading it, and he said, what on earth would this guy say? He's learned very quickly how to become a senator, you know, responding with stuff that you can't even understand. There's no position, there's no committal to anything. So, and then it goes to your House leader, depending if you have a good or a good House representative or not so good, but you'll find out really quickly. And this is sitting in their lap, and this is a hot potato. They're going to get a lot of backlash next year if they vote wrong on it, because you jack taxes that high. And by the way, one more thing I want to say about this. The White House has been talking about the possibility of making it retroactive back to April. Now, I don't know how you can do that. I talk to tax people and they say, you can't do that. But that's what they're asking for.
So I think it's also tough anytime you have legislation being made by legislators who are not really experts in tax law or frankly reading thousands of pages of documents on a short notice to come up with these laws. So that's always tough, no matter what's happening. Well, as a real estate investor, I can say I hope this doesn't go through, obviously, because I don't want to pay more tax on 1031 exchanges. So I hope it doesn't go through. But let's switch gears and go back to questions from any of our members. So if anybody who's on the call right now has a question, please go ahead. It's definitely going to help also the majority of our members who are actually going to be watching the recorded version tomorrow or the day after.
Sure.
So you guys can feel free to unmute yourself if anybody has a question. I think we have covered a lot of it through our discussions.
You did a good job. I'm impressed with all your questions. They were great.
Thank you. But yeah, I'm still hoping that if anybody has any questions, to go ahead and unmute yourself and you can speak now.
I have an off-the-wall question for you, Phil.
Sure, Nick.
Okay, if you have a property that's a total loss, it's deemed a total loss and insurance is going to pay you out. And there's going to be potentially there's additional money on top of once the property's been paid out, that would be viewed as, and it's going to get taxed. In that scenario, instead of if you didn't rebuild that property, but there's I guess you can actually assign another property and purchase another property within the same area so to capitalize on the rebuild cost, the total rebuild cost of that property, instead of it being depreciated. Let's say that the house depreciated down to 100 grand, but the payout was 300 grand. So it might be more advantageous to rebuild or purchase another property. Would you be in that scenario? Have you ever come across anything where someone has been in that scenario and they've done a 1031 to capture?
Actually we have.
And this is completely hypothetical, right, Nick?
Actually,
That
it's
is
not.
correct.
Remember the wildfires that we've had in the Southland? We've
Yes.
had some people, like especially up in Big Bear and Arrowhead, and like that.
Yep.
We've had people, you know, or even the Thousand Oaks and Ventura fires.
Yep.
You know, that insurance money's boot. You know,
It's what?
it's boot. It's taxable. So what you said earlier was just right on target. You know, it's probably better to rebuild the property, sell it, do a full exchange on it. And I think that's a good way to go. If there's a better strategy, maybe your CPA can come up with something.
Yeah.
Would be better.
But to buy another property that's got a higher value with that money, there's no way to 1031 exchange it that way?
I don't know. I would be guessing. I would have to check with the legal department. So
Okay.
if you want, maybe we can connect in the next couple of days, and I'll talk with them and bring that scenario back up. And because it's been so long since those firestorms, I kind of forgot the answer to it because I haven't had a question on that in a long time. So, but I can find out and let you know.
Sounds good.
I also wanted to ask Phil, so speaking of getting in touch with it, before we wrap up, I wanted to see if you could share your contact information in the chat box below.
Sure. I'm working off my laptop and I hate typing on my laptop.
That's okay.
I use one of those for my computers. I use one of those ergonomic jobs.
You can also tell me if you want. I can type it down here.
Could you?
In chat. Yeah, no problem at all. So you go ahead.
My email address, I think you sent me an email this afternoon.
Yeah.
At philatwan@gmail.com, or was it P.Atwan@exchangeresources.net?
You know what? I'm going to find it here and I'll go off with that.
And I can give everybody my phone number after you do all that, or I can do it now. It's area code 213-479-8800. There you go. Beautiful. P.Atwan@exchangeresources.net, 213-479-8800. Absolutely. That's how you get a hold of me, either one of those.
Okay, that's perfect. I've also put my contact info above there because, like I said, I've been doing this for a long time. And if anybody wants to talk real estate in general, I'm always open. You can always text me on that number or email me. My email address there. So yeah, thank you, Phil, for sharing your contact info.
My pleasure. Thanks for having me on the show today. I feel very honored.
Thank you. Does anybody have any last minute question? We'll take one more question if you guys have it. If not, we're going to wrap up.
Sounds like we're wrapping up.
I will take that as a no. So yeah, we're going to wrap it up at this point. Thank you, Phil. I know a lot of folks are going to find this useful, including the members that are watching this afterwards. And I know you mentioned previously that you have a PowerPoint, and we can actually, if you still want to, you can shoot me that PowerPoint over, and I'm going to include it on our club500.us website alongside the video of our conversation.
I'd be happy to, Nick. Peter, sorry, Nick's down there.
Sounds great. Yeah, thank you guys. Thanks, Nick, for the introduction, and finally, thank you, Phil. And we'll see you guys next week. We have a real estate attorney, coming to our next meetup. If you guys ever want to know about our meetups before they happen, text the word club to 474747. It's free. You'll get a reminder once a week when we have our meetups, and we'll see you guys next week.